You built it. 10 years, maybe 15. And this morning a number landed in your inbox that would have sounded like a typo to your younger self. $50 million for your company. Signed, agreed, closing in 90 days. So here's the strange thing nobody tells you about this exact moment. The day you sell your business for $50 million is not the day you get rich. It might be the day you find out whether you already were. Stay with me, because the gap between those two things is where almost everyone loses a fortune they technically already had. Let's drop into it. The first hours. You're sitting in a conference room, or maybe your kitchen, staring at a document. The buyer's team is enthusiastic. Your lawyer slides one page across the table and taps a line near the bottom. And that line is where the fantasy meets the machine, because you've been picturing a single wire transfer. $50 million, whole, landing in your account like a wave. That is not what happens. What happens is that the number breaks apart in front of you, into pieces, and some of those pieces you will not see for years, and one of those pieces you will never see at all. You think the sale price is the money. The truth is the opposite. The sale price is the headline. The money is whatever survives the trip home. So let's follow it home. The first week, the illusion is still intact. Congratulations are pouring in. Someone you barely know suddenly has a can't-miss opportunity for you. Your inbox is warm, and in that warmth, it's very easy to make the first mistake, the one almost everyone makes, which is to start spending against a number that isn't real yet. Because part of that $50 million never comes as cash. A chunk is held back in escrow, sitting in a locked account for a year or more. Insurance, in case something about the business turns out to be less true than you promised. Another chunk might be an earnout. Money you only get if the company keeps hitting targets after you've handed over the keys, which means you can sell your business and still spend the next 3 years quietly praying it does well without you. And your ownership stake, your equity, may not even be the whole company. Investors, partners, that early loan you converted, they all get their slice off the top. But say you owned most of it. Say the clean number, your number, is 40 million. Feels enormous. It is enormous. Then the machine takes its cut. And here is where the first real lesson hides. When you sell a business, the government doesn't tax the 50 million, or even the 40. It taxes your gain. The difference between what you sold it for and what it cost you to own, your basis. If you built the thing from nothing, your basis is small, which sounds good, until you realize it means almost the entire sale is gain, and gain is what gets taxed. Now, if you held that ownership long enough, that gain is usually treated as a long-term capital gain, and this is the part the wealthy understand in their bones. Long-term gains are taxed more gently than the salary you used to pay yourself. A paycheck can be taxed at rates climbing well past a third at the federal level. A long-term gain sits far lower. That difference, the gap between how income is taxed and how ownership is taxed, is not a loophole. It is the entire reason the rich would rather own things than earn things. You just lived the lesson without noticing. You didn't get wealthy by being paid. You got wealthy by owning, and then selling what you owned. Quick honest note before we go further. This is a scenario, a thought experiment, not advice, and the exact numbers bend depending on where you live and how you structured things. But the shape of it is real, because here's where it gets strange. Federal is only the first hand reaching into the pile. Depending on the state you built your company in, a second hand reaches in, and in some states, that hand takes almost nothing, and in others, it takes another double-digit slice. Two founders, identical companies, identical $50 million sales. One keeps millions more than the other, and the only difference is a line on a map. So that opportunity you were told about, the one about founders moving before they sell, that wasn't a lifestyle choice. That was someone quietly doing the math you're only now learning exists. Let's total it up. The first month, the wire finally clears, and you look at the real number. Not 50, not 40. After the federal cut, after the state cut, after the extra surtaxes that ride along on big investment income, you might be looking at something closer to 28, maybe 30 million, with a few more million locked in escrow you'll get later if nothing goes wrong. And your first reaction is not disappointment. That's the trap. Your first reaction is relief. Because $30 million is still an almost unimaginable amount of money, and relief is the emotion that has quietly destroyed more sudden fortunes than any market crash. Because the hidden force starts working the day the money lands, and it isn't the tax man anymore. He got his. The hidden force is you. 30 million in an account generates a feeling no financial statement can measure. It feels infinite. It feels like the counting is over. And so you begin, gently, to treat the principal, the actual pile, as if it were income. A house, because you earned it. Then a better house, because why not? You help family, which is beautiful, and you help them again, which becomes expected. Each choice is reasonable. Each choice is small against 30 million. That's the danger. The pile is so large that nothing you buy ever looks big enough to hurt it. But a pile that only shrinks has a name. It's not wealth. It's a countdown. So the first year forces the real decision, the one the whole video has been walking toward. You have to choose what this money is. Is it a prize, or is it a machine? Because here is the mechanism the truly wealthy live by, and almost no one is ever taught. They do not spend the pile. They spend what the pile produces. $30 million, placed into things that generate a return, can throw off a meaningful income every single year without the 30 million ever getting smaller. The rich person and the lottery winner can hold the exact same amount on the exact same day. The difference is that one of them eats the eggs and the other one eats the hen. One lives off the yield and dies with the fortune intact, or larger. The other lives off the fortune and watches it evaporate, confused about where it went, because every single purchase felt reasonable at the time. You think wealth is the number in the account. The truth is the opposite. Wealth is whether that number can feed you without being eaten. But even that isn't the end of it. Because now a new problem appears. The one that only shows up once you've been careful. Say you do it right. You live on the yield. The pile stays whole, maybe grows. 10 years pass. 10 years later, you are not the person who sold that company. You barely think about it anymore. The stress of the sale, the escrow you sweated over, the earnout, all of it has faded into a story you tell at dinner. And the 30 million, treated as a machine instead of a prize, has quietly done what machines do. It ran. It compounded. It may well be larger now than the day it arrived, even after everything you spent, because you only ever spent what it made. And that's when the twist lands, the thing that recontextualizes the entire day you sold. The $50 million sale was never the moment you got wealthy. It was the moment you got tested, because the money didn't change who you were with money. It revealed it. The founder who understood ownership and timing and yield was already wealthy in the way that matters, years before the wire ever cleared. The sale just handed them a bigger version of the discipline they already had. And the one who wasn't ready, the one who felt that warm relief and started spending the hen, was going to lose it, whether the number was 5 million or 500. The amount was never the deciding factor. The amount just changed how long it took. So let's close the loop we opened at the very start. I told you the day you sell your business for $50 million might not be the day you get rich, but the day you find out whether you already were. Now you can see why. Rich isn't the headline number on the contract. It survives taxes you didn't see coming. It survives states and structures and the escrow you forgot about. And most of all, it survives you. Your own hand reaching into the pile in 100 reasonable little moments. What lands in the account is not wealth. It's a raw material. What you do in the quiet year after is what turns it into something that lasts, or something that simply took a little longer to disappear. Here's the part I want you to actually sit with, because it's true whether your number has 7 zeros or you're still building the thing that might one day have them. The habits that keep 50 million are the same habits that build the first 50,000. Spend less than you make. Own things instead of just earning. Live on what your money produces and protect the machine that produces it. Nobody grows into those habits after the money arrives. The money is far too loud by then. You either bring them with you or you watch, politely and reasonably, as it all slips away. So if you ever get that email, the one with the number that looks like a typo, remember that the wire clearing is not the finish line, it's the starting gun. The real question was never how much they'd pay you for what you built. It's whether you'll be the kind of person who still has it, 10 years after everyone stopped being impressed. Sit with that one for a second, and if you want to see how the same hidden machine plays out from the other side, the day the money doesn't come from a sale, but from a will you were never supposed to read, that's the next scenario. Take care of the hen. The eggs will take care of you.